Okay, the fractal market. Now, we just talked about this a little while ago, but we're going to expand upon the idea of the fractal market. The market is fractal in nature, which means the same patterns occur at all degrees. The same patterns we see on a monthly chart, we will see on a 5-minute chart. Okay, smaller degree time frames are more susceptible to intraday volatility and data events, simply because we're talking about much smaller swings, so the volatility is obviously going to affect those more. But what this shows you, this is what makes pattern trading so versatile, because it can be used on any time frame for different types of traders. Okay, whether you're an intraday trader and you're trading off of 5-minute charts, you can use this methodology. If you are trading short term and you're using 15-minute and 1-hour charts, you can use this methodology. If you're trading medium term using 4-hour charts, you can use this methodology. And if you're trading longer term, you're using daily and weekly charts, guess what? You got it. You can use this methodology. Okay, so I told you I was going to start showing you a lot of visual evidence of the methodology, of the patterns we're going to look for, and I'm going to start to do that right now. We're going to go ahead and look at the higher time frames and some smaller time frames just to prove this point. We're going to get a little bit more into the actual patterns here in the next few slides, next few sections. But right now, just very basic, I want to go ahead and run through a couple of charts here just to show that these patterns we see on the higher degree time frames, we also see on the smaller degree time frames, effectively giving the evidence for the fractal nature of the market. Okay, so here is a weekly chart of the dollar-yen. I'm just going to run through this chart, and I'll start right here, and we're just going to measure this, see the 3-wave cycle right here, and I'm just going to measure this from the low to the high. We're going to pull this back, and you can see we moved into what we call the 100 to 127% Fibonacci projection zone. All right, so basically the third leg of this cycle, or the C wave, we projected that out to the 100, 127% zone where we found support, and then the market started to turn. Right now, let's go ahead and get rid of that. We're going to move over to this particular swing in here. All right, we're going to use our same tool. Okay, we're going to use that same tool. See how the market came to a low right here? I'm going to measure actually this little swing right here. Let's just measure that. Okay, we're going to pull that back. Where did that move? From the high to the low? That looks like equal legs, right? 100%. Absolutely. Now let me go ahead and get rid of that, and let's do another measurement here on this entire cycle right here, from this high to this low. And where did that move? Equal legs 127. Right, then found some resistance there and pulled back. Right? All right, let's get rid of that. And now I'm going to measure the entire cycle here. We're going to pull that back to the low, from the high to the low here on the correction, to the rally. Where do we end up? Equal legs, 127% zone. Right here we ended up right at the equal legs level before seeing a larger corrective setback. Now, let's just, for fun, let's measure this corrective setback. Well, what do you know? Equal legs, 127. 3-wave setback, equal legs, 127. This is a weekly chart, folks. This is a weekly chart. Okay, so anybody that's going to tell me that the markets aren't patterned here, that aren't measured and patterned mathematically, you're not being very objective when you are considering these types of methodologies. Now, I can already look at this particular cycle and see that it didn't quite make it. And let me just go ahead and show this. Get our drawing tool here. And I'm going to measure from this low, or the high to the low here. And I can already see that this leg didn't make it. Now what this probably did, and let's just see, it probably made it right to the 62. Not the extension, not the projection to 162, but the 62, and that's another bullish pattern that we'll see. That's something we'll learn here in a little while. But if I put on that Fibonacci there, you'll see that's where we came to, this initial rally, We stopped right there at the 618. Then we pulled back. Then we continued on that cycle, creating a three-wave cycle. Okay, but just the fact that this only moved to that 618 and pulled back was a bullish sign. Okay, but again, I'm getting a little bit ahead of myself here. A little bit ahead of myself. Okay, then obviously this cycle fell a little bit short of reaching the equal legs, but you know, it's not perfect. There's going to be times where we're not going to be perfect all the time, but I think we're going to show enough evidence here that's going to give us probabilities. The other thing we had here that's very important to see is divergence. Okay? See how the MACD down here made a double top? Price is moving higher. That is a negative divergence. This is a qualified divergence once this declined, which is a very important part of our trading strategy, because this would have been an area on the pullback that we were looking to go short. All right, now to save some time here, we're going to look at this particular pattern right here. We're going to measure this. Initially, right here, we're going to look at this individual cycle. All right, I'm going to measure this right here, three-wave cycle to that low. There's the bottom of the third wave. Here's the X-wave setback. Equal legs. Okay, so we moved right to equal legs. Now we had a larger pullback. Let's go ahead and measure that pullback. So now we're going to take the entire cycle. We're going to measure that out. I'm going to project this out to the future here. I extended it over here so we could really see this down to the bottom. And you can see that this next cycle also, which subdivided, moved into the equal legs 127% zone before turning and reversing. Another thing we can see here, if I draw it on this particular cycle, we analyze the individual swings in this cycle from the low to the high. Okay, look at where that falls. Okay, here's the equal legs level. From this low to this high, the market moved down to equal legs right here, effectively ending this cycle. And how did this cycle end? With divergence. This is also a pattern we'll talk about. This is an ending diagonal. This is a pretty common Elliott wave pattern as well for ending cycles. Some of you may be familiar with the term wedge. Okay, but a lot of times what you'll see in a wedge is that price will diverge all the way through it with the momentum indicator. Okay, so all the way through these lows, divergence, 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 all the way through. Okay, that is a very bullish pattern that ended right at the equal legs level of the smaller pattern and right in the equal legs 127% zone of the larger pattern. Anybody out here still want to tell me the markets aren't patterned? Okay, now raise your hand if you think the equal legs to 127% zone is an important zone. I'm just kidding. You can put your hands down now because nobody can actually see you. And that's one of the reasons I really like, I enjoy teaching this stuff live because my jokes get a much better reaction live. You know, go figure. But anyway, no, in all seriousness, folks, we're going to show time and time again these same patterns in the market. Okay, now obviously, you know, we talked about everything being a probability. You know, nothing is it's never perfect. You know, there's always exceptions, but you're going to see this enough times over and over and over repeated to understand that it's going to give you a high probability when we're looking at entries and targets in this market. Let's take a look at a smaller degree time frame. Okay, so here's a dollar-yen 5-minute chart. Now let's go ahead and just measure some of the cycles out here. We're going to measure from the low to the high. Okay, you can see here that the market, we traded a bit through that equal legs 127. If we didn't make it to the 162, that's what really matters there. And even if we did, that is a bearish sign. Okay, that's another pattern we're going to teach you. It's called an extension. Okay, when we see this cycle extend, that's a bearish sign. Okay, so now we're going to measure, actually before I do that, let me just go ahead and take off that so I don't get confused. Let's go ahead and measure the entire down cycle here. So now we're going to take it here from the entire cycle, from this three-wave cycle here. We're going to measure it right up to the top. We're going to just drag this over so we can see where this next cycle completed. You can see the next cycle ended in the equal legs 127% zone. And look what happened here. Just like we saw on the weekly chart, we ended in this diagonal pattern. Okay, and see how the MACD diverged all the way through that diagonal before the market reversed. Okay, so this is the 5-minute chart. The same thing, basically the same thing we just looked at on the weekly chart. Patterned market, fractal markets make pattern trading and divergence trading an excellent strategy for any type of trader.